Hello everyone, welcome back. This week we will be covering Chapter 5, which is regarding merchandising operations. In the last 4 chapters, they focused on the complete accounting cycle. You learned how to analyze business transactions to determine which accounts in the accounting equation are affected. You journalized transactions posted on ledger accounts. You prepared a trial balance. You adjusted entries. And based on the adjustment entries, you prepared an adjusted trial balance. You know how to prepare financial statements now, which include the income statement, the owner's equity statement, and the balance sheet. And then you learn how to close entries. And then finally, you prepared a post-closing trial balance. So if you think about it, you have learned a lot in the last 4 chapters. And you're probably wondering what's next. We are now going to take up these basic concepts that you have learned in terms of the complete accounting cycle, and you are going to be applying them to the merchandising operations. Okay, so the last 4 chapters, like I said, focused mainly on businesses that provided a service to its customers. So businesses that provide a service include businesses such as bookkeeping services or accounting services, insurance companies, or legal firms. So merchandising operations will concentrate on businesses that sell goods or merchandise. Now, these businesses are known as retailers, which are companies that purchase goods and sell directly to consumers. And some examples of such companies are like Walmart or Target, or consider your mom and pop stores that are around your neighborhood. Those would be retailers as well. Now, those businesses must obtain their goods from somewhere, right? And in order to make the biggest profit possible, the goods must be purchased in large quantities and at a low price. So there are companies that sell in this manner and are known as wholesalers. And the book gave you examples of wholesalers that include like the United Stations that supply goods to Office Depot. But your local mom and pop stores may not buy from wholesalers that are that large because maybe the mom and pop stores are not capable of buying massive amounts of merchandise. They may need wholesale prices, but in smaller scale. So your local mom and pop stores around your neighborhood may obtain their goods from Sam's Club or Costco. Okay? Now, when we dealt with businesses that provided a service, we found that their main source of revenue came from payments from those services. For merchandising companies, the main source of revenue comes from the sales of the merchandise. So this illustration shows the process of merchandising companies. And if we focus only on the green boxes, you can see the process for a business that provides a service. Basically, the business provided a service and received revenues in return, right? And then the business subtracted the cost of operating expenses, and those operating expenses included stuff like rent expense, employee payroll, or cost of supplies. And that was subtracted in order to determine if there was a net income or a net loss at the end of a period. And remember that a period could be monthly, quarterly, biannually, or even annually. Now for merchandising companies, we add the 2 blue boxes to this process. And basically, merchandise companies takes the sales from the merchandise and subtracts the cost of goods sold in order to determine the gross profit. Okay, so this subtraction gives you the gross profit, which then you subtract the operating expenses to determine the net income or the net loss. Now, because merchandise companies rely on revenue from the sales of goods, the company must buy goods that the company can sell. So, in order to purchase, the purchase of these goods increases the operating cycle. And I have two examples to show you the difference. This illustration at the top shows the operating cycle of a service company. Okay? So you basically provided a service, and then you sent a bill to your customer so that you can record that the amount of the expected revenue in accounts receivable, and then your customer sent a payment via the mail, and then you receive the cash once you receive that payment. For a merchandising company, you must first buy your inventory from a wholesaler. Then you receive the inventory, and you may put it on the shelf or you may put it on the internet to sell it. Okay? When you make a sale, you may not receive your cash on the spot, perhaps because you sold it on credit or you sold it on the internet and you have not received your cash yet. So you send a bill to your customer and you record the expected revenue in accounts receivable, and then your customer sends you the payment and then you receive the cash. So as you can see, a merchandising company has a larger operating cycle than the service company. Okay? So now we know that for this chapter, we will be dealing with inventory. Okay? And to account for inventory, companies use one of two systems. We have the perpetual system, and then we have the periodic system. Okay? The perpetual system is when a company continuously, that's why I put it here in parentheses, is when the company continuously records the cost of each inventory purchase and sale. So the easiest way to remember this concept is, or the easiest way to remember what a perpetual system is, think about scanners. Any business that has a scanning system to record a sale, it has a capability of running a business with a perpetual inventory system. This allows a company to determine the cost of goods sold each time a sale occurs, okay? A periodic system is when a company determines the cost of goods sold at the end of the accounting period. So it is not continuous, it is periodically. Okay? So let's think of Costco. Costco has scanners, so they run a perpetual system inventory. But I also know that they have inventory nights where employees take a physical inventory count to determine the cost of goods sold on hand. Okay? So in a way, Costco also runs a periodic inventory system. Now, in order to, the process that it involves under the periodic system is you first determine the cost of goods sold on hand at the beginning of the accounting period, and then you add the cost of goods purchased during the period, and finally you subtract the cost of goods sold on hand at the end of the accounting period. Okay? And in this chapter, what we will be doing is we will be focusing on the perpetual system. Okay? And the reason for that is that more and more businesses, including mom and pop stores, are moving into the scanning systems, which allows them to easily move into the perpetual inventory system. So how do we record purchases under a perpetual inventory system? When we buy goods, we can either pay with cash or credit card or a credit line, whatever that payment will be. And so regardless of the form of payment, it is very important that you keep records and documentation of the purchase. And this can be by saving the sales receipt or by saving a invoice. Now, this illustration is of an invoice, and it is very, very important that the invoice has an invoice number, the information of the company selling the goods, and the information of your business. And it's also important to show the date of the transactions, the amount owed, and the description of the goods that you purchased. And then also notice that there are two fields. We have the terms, and then we have the FOB shipping point. And I will explain those in a minute, okay? But in order to explain the terms a little better, we have 2/10, comma, and /30. Well, the way that you actually read this term is you read it as 210 net 30. Okay? And what this basically means is that you can take a 2% discount, on the total invoice, okay, if you pay within 10 days. So here the invoice is for $3,800. If you pay within 10 days of this invoice, then you are entitled a 2% discount. So you don't have to pay $3,800, it'll be less, 2% less. If you don't pay it in 10 days, then this net 30 means that you have 30 days from the invoice date to make the full payment of $3,800. And I will explain this in the next few slides, okay? So let's go to our first example. And this will illustrate how to record the purchases of goods, okay? And we're going to assume that the purchases are done on account. Remember that in account, when you do things on account, it means that you will pay the company at a later date. So let's say that we buy $3,800 worth of inventory, okay? And we're going to buy them on account. We would record the transaction by debiting inventory. And we debit because we want to increase the inventory account. And then we credit accounts payable because we also want to increase the amount that you owe for that account. Now, this is a time for me to remind you that to take out your cheat sheet that you used for the previous chapters, that shows you, it's that table that shows you whether you're increasing or decreasing an account depending if you're dealing with assets or liabilities or owner's equity, okay? Because I will be explaining these examples. I will be telling you you're debiting because you are increasing or decreasing the account, or you're crediting because you're increasing or decreasing the account. So I don't want you to get lost. So take out that sheet and continue listening to my recording, okay? Now notice that the inventory is a new account, okay? We have not used this account before in the previous chapters. So one thing to remember is that inventory in merchandising companies is considered an asset, okay? Just like in service companies, the assets was the supplies account, okay? So when you deal with inventory, remember that it's an asset. Now let's focus on the FOB shipping point. You're wondering, what does it mean? Well, when you buy inventory that is going to be shipped to you, the seller may ship the inventory and charge you for the freight costs, or the seller may pick up the cost of the freight. And basically, freight means the transportation cost, that the cost of the transportation that will get those goods to you. So, if the invoice can state one of two things. If the invoice states FOB shipping point, this means that the buyer will pay for the freight costs. Okay? Or it may state FOB destination, and which this means that the seller will pay for the freight cost. Okay? So when the buyer pays for the freight cost, or in this case, the transportation costs, the buyer will record the transaction by debiting the inventory and by crediting the cash account. Very simple, straightforward. When the seller pays for the freight cost, the seller will record this as an operating expense. So it is recorded by debiting the freight out or delivery expense. This is also a new account that you will be working with on this chapter. And then you credit cash for that amount. Okay? Straightforward. So now you know how to record transactions when merchandising companies buy inventory goods, and it also includes the way to record when you're processing freight costs, whether you're the buyer or the seller. So what happens if the buyer decides to return merchandise? You know that depending on business policies, you as a consumer can return merchandise, and you can return it because it's defective, or you may simply not like the product, so you just want to return it and get your money back. So if your business needs to return inventory to your wholesaler, you will record this transaction by debiting the accounts payable. And you do this because debiting will increase the amount you owe. And then you credit inventory because you will also be decreasing your inventory. Okay? Now, an alternative to returning your inventory, your business can decide to keep the inventory but negotiate a reduced price. So let's say that you received something that was scratched. It had a little scratch, but you could still use that good and sell it. So you may want to keep it, but you want to not pay the full price. You want to pay a reduced price for that scratch. So when this type of negotiation happens, you record this transaction as an allowance, okay? And this is done in the same way as illustrated here, okay? But you will do the same thing. You will debit the accounts payable by the negotiated price reduction, since you now will owe less money to the wholesaler, and then you credit your inventory by the same amount since your inventory is now worth a little less, okay? Now, you remember that I explained earlier what the 210 net 30 means. Remember? Let's go back to that invoice. This terms 210 net 30. Okay? Remember that it means that you read it as 210 net 30. And what that means is that you can take a 2% discount if you pay the invoice in 10 days. Okay? Otherwise, remember, like I said before, you have 30 days to pay the invoice for the full amount. Now, companies offer this as an incentive for the buyers to pay sooner, so that the company does not have to wait a longer period to receive their cash revenue. So if your business decides to take the discount, you will need to record the transaction to reflect the discount. Okay? So by taking the discount, you have to reduce the value of your inventory. Remember that in the previous example, when the business decided to keep the inventory received, but it negotiated a lower cost for the goods? Well, the business also had to record the transaction to reflect the new value of the inventory, right? The reason we do this is because businesses must record inventory at cost. Not what the value is, but at cost, what you paid for. So in this example, a business purchased goods or inventory for $3,500. And a 2% discount is going to be $70. Okay? So a 2% discount on $3,500 is actually $70. So in reality, the business is only going to owe the company $3,430, not $3,500. Okay? So the transaction should be recorded by debiting accounts payable, because we want to reduce the amount that we owe to the company since we are going to pay it off. And then we want to credit cash because we will decrease our cash account by $34.30 and also credit inventory since we are getting a 2% discount of $70. So we want to reduce the cost of the inventory by $70. Okay? So what happens if you don't take advantage of the discount? Then you're just going to record this like you have already learned in the previous chapters by paying the full amount. So you are going to be debiting accounts payable by $3,500 and then crediting the cash amount for the same amount. Okay? Now all of these transactions that I just showed you are for purchases under the perpetual inventory system. So now let's take a look. Let's change the role. And now we're not going to be buyers, now we're going to be sellers. So these next examples will show you how to record transactions as a sale under the perpetual inventory system. Okay? When your business sells, you may accept a payment in cash or a check or a credit. And with purchases, just like the purchases that I showed you earlier, you also have to document the sales with evidence. And this can also be in the same manner, either a receipt or an invoice. So when the business records a sale, the difference is the difference between buying or selling is that when you are selling, you have to enter 2 entries. You have to record 2 entries versus 1, as in the previous examples. So in order to record the sale, the first entry would be to record the sale, and you do that by debiting the accounts receivable. Okay. You can also use cash instead of accounts receivable if you receive cash for the sales. But in this case, remember we're assuming that everything's done on account. So you will be debiting the accounts receivable, and then you would credit the sales revenue for the same amount since you are increasing the revenues account. Now, once you record the sale, the second entry that is required is to record the cost of goods sold. You do this by debiting the cost of goods sold account. This is a new account that you'll be using. Okay, and that's because you want to increase your cost of goods sold account, and then you credit your inventory since you want to reduce the inventory on hand. Okay. So you know that consumers will return merchandise for the same reasons that you may return your inventory. So when your customers return goods, you need to record that as well. And this will also require 2 entries. First, you need to record the return of the item sold by debiting the sales return and allowances account. This is a new account as well. And you are going to debit it. You're debiting because you will increase this account, and then you credit accounts receivable since you want to decrease the amount of money that you owe to your business, that you owe to that business that. Okay? The second part is that you must record an entry to capture the inventory levels and the cost of goods sold. Now, since your customer is returning goods to your business, you will need to debit your inventory, and you're doing that because debiting increases the inventory account, and then you credit cost of goods sold since this decreases this account. Okay? Now, this same process also applies when you negotiate a discount with your customer instead of agreeing to a return. Okay? And you would record it in the same way as here, and that's why you can see the account sales and returns allowances since it applies to both. Okay? Now, remember that your wholesale company offered a 2% discount for paying within 10 days? Well, you can also offer something similar to your customers to incentivize them to pay you sooner. And so let's say that you offer the same 2% discount if they pay within 10 days and the customer pays you within the discount period. So you will record this by debiting your cash account since you are increasing this account. And then you're also going to debit your sales discount to reflect the discount amount. And then you're going to credit your accounts receivable since you want to decrease this account to reflect the payment to your business. Okay? Now, back in chapter 4, you learned to adjust entries. And you learned to close entries. And this was done for service companies. Well, this also applies to merchandising companies. I will not go over the process again since it's identical to what I showed you in chapter 4. So if you need a refresher, go back to my chapter 4 lecture. What I will show you is one additional adjusting entry that is not covered in chapter 4, but it's required when dealing with merchandising companies that use a perpetual inventory system. So remember that under the perpetual inventory system, your business records the inventory levels after each sale. Okay? However, just because you record your inventory after each sale, it does not necessarily mean that you have an accurate inventory record. You're wondering, well, why not? Well, unfortunately, inventory can get lost or stolen. So what you actually have in your warehouse or on the floor of your shop may not match exactly what your scanners are recording. So let's go back to my Costco example. They use a perpetual inventory system, but also physically take inventory during certain periods of the year. Remember I said that? They do this so that they can reconcile the inventory levels. So in other words, they take physical inventory so they can match the actual inventory levels with their levels recorded on the books. Okay, they're reconciling. This is a reason you need to make one more adjusting entry to what you learned in chapter 4. So in this example, I'm just not going to read the example, but just give you the general overview. So let's say that your books show that your inventory balance, it has $40,500 in inventory. But when you physically take the inventory, you notice that you actually only have $40,000 worth. So this is actually a $500 discrepancy. It does not match by $500. So what you need to do is that you must make an adjustment to your books. And you do this by debiting cost of goods sold, okay? And by crediting inventory. And you do this by the amount of the discrepancy. Okay? Now, merchandising companies must also close the books, the accounts. And you do that in the same manner that you learned for service companies, but you follow these steps right here to close the entries. Remember when you learned about closing entries, it's just following what it says. You would do the same thing as stated here. So the last thing to cover for this chapter in terms of merchandising companies is to go over the financial statements, okay? Remember that for service companies, The income statement takes the sales of the revenues and then it subtracts the expenses in order to determine the net income or the net loss. Okay? Well, now I'm going to show you what they call a multiple step income statement. Okay? We just covered several scenarios that applies to merchandising companies. We covered returns, we covered allowances, discounts, and cost of goods sold. This is the reason we have a multiple step income statement. So when we deal with merchandising companies, we record the income statement to reflect these accounts in order to determine the net sales or net loss. So in order to do that, for the one-step income statement, you just took the sales revenues and then you subtracted the operating expenses and you got the net income. Now you can see that this is multiple step is longer. Just like the merchandising operating cycle is longer, your statements are going to be longer. You are going to make sure that you reflect the sales revenues, and then when you do the sales, you have to make sure that you subtract any returns that occurred during the period or any allowances that you approved or any discounts that you provided. And that's going to give you the net sales. Once you have the net sales, you're going to have to subtract the cost of goods sold. Okay? Because you can't take all this into consideration as a profit. You have to minus the cost of each item that you sold. That's going to give you the gross profit. Once you do the gross profit, then you do it like your one-step income statement. You subtract all of your operating expenses. Okay? And then you also include income from operations like interest revenue or disposal of plant assets or any other losses. Maybe somebody stole property, goods from you, so you're gonna have to record those as a loss. Okay, you record that. Then after you subtract all that, then you determine your net income or your net loss. You're gonna determine if you actually made a profit or you did not. Okay, and that will be it for chapter 5. So let me take you to your homework assignments. Let's see if it's this one. No. I'm gonna have to log in again. So for your homework assignments, it's right here. You have your lecture assignment, your homework, and your quiz. Your lecture assignment is just like the previous chapters. You have to read the book. That's just my way of assuring that you're doing the reading. And your homework assignment, see if it loads. It's going to have 3 problems. And basically, you're going to be doing journal entries to record using the perpetual inventory system. And I showed you how to do that. Okay, so you're going to be doing those recordings. And then it's going to ask you to take the role of the buyer and then to take the role of the seller. So it's going to give you information that's happening between 2 companies. It's the Diaz company and the Taylor company. And you're going to be preparing entries for each transaction as if you're the Diaz company. Okay, the Diaz company is purchasing. Okay. And then you're going to be taking the role of Taylor company, which is the seller. You're going to be doing the recording the transactions as well. Okay. And then the third example or the third homework assignment is to be preparing a multi-step income statement and a single-step income statement. So remember the multi-step. You're going to be doing the net sales, then you're going to be reducing the cost of goods sold to get the gross profit. Then you're going to be deleting your operating expenses. You may have interest revenue or some vandalism going on, so you record that, and then you get your net income loss. For the single step, remember, it's like you've done it before. You have your revenues in terms of your net sales, and then you subtract all of your expenses, your operating expenses, in order to determine the net income or your net loss. Okay, now these, don't even think about just copying, because guess what? You guys all have different numbers. Okay, so that's pretty much it, what you have to do for this chapter. You also have a quiz, and it's similar to the homework assignment, just to make sure that you are understanding the concepts of this chapter. If you have any questions, like always, just send me an email now, and I'll get back to you. Okay? Good luck to you.